What are liquid and ultra short-term funds? Will they replace your fixed deposit? This is Deepak Shenoy taking you through Market Vision's module on mutual funds. And let's start away with what is liquid. Liquid is basically something you can convert to cash very easily at its current value within a short period of time. So a house or a car is not really liquid. So if your neighbor has sold his house for 56 lakhs, it doesn't mean that you can get 56 lakhs for your house any reasonable amount of time. You might have to deal with less, and it may take you 6 to 7 months to get it. So liquid, a more example of an example of a liquid instrument is a fixed deposit, where you you can go to the bank and give back your fixed deposit and say, well, give me my money, and they'll give you the money with whatever interest is accumulated, minus any penalties, within a day or two into your account. So you get to use the money. It's very liquid. Do liquid funds mean that your money can be easily redeemed? Well, no, because nearly all mutual funds are liquid by definition. Within 2 or 3 days, even an equity fund, the fund that invests in equity markets, will give you your money back. What then is a liquid fund? So simply put, liquid mutual funds invest in very short-term debt or short-term paper. There are corporates and banks that borrow money from various kinds of markets, sometimes as little as overnight. I want 10 crores, I'll return it to you tomorrow, versus they might invest all the way to 10 years. And the idea here is that there is a market where you say, I will issue some paper, I will borrow say 90 crores for 50 days. And then what happens then is that people on the other end buy this paper. And it's not people, because it's not you and me, because every single security here is about 10 lakhs of face value, and trades are of the order of multiples of crores, typically 5 crores and above. So it's not for you and me, it's usually for large institutions and mutual funds and so on. They buy this paper from the corporates and from the banks, and then they trade it within each other. You and I, for instance, if I buy a fixed deposit, I can't sell it to you. But in these debt markets, the deposits itself can be sold between players, and there's a tradable market itself. We'll go to that in a different session, but the concept is that this is a large bulk market, and liquid mutual funds are simply those that invest where these securities have less than 91 days left to maturity. When I say maturity, that's when you get your principal back, right? And if you look at ultra short term funds, they kind of go a little bit above. They say, well, we'll invest in the same kind of securities, except we will invest in more than 91 days also. So we can invest in less than 91 plus a little bit more, however we'd like to choose it. So that's just the difference between liquid and ultra short term funds. Now, where do these liquid and short term funds invest? There's something called a CDCP market, which is the certificate of deposit and commercial paper markets. Certificates of deposits are issued by banks, commercial papers issued by corporates. The tenure of this paper is usually has to be less than 365 days. And what happens here is that certificates of deposit from banks are traded, commercial paper from companies are traded, and this is where liquid funds and ultra short term funds may come and buy as well. They might also choose to buy treasury bills, which is the same concept, except the debt is issued by the government. The government will say, listen, I want 10,000 crores and I want for 90 days. So they will issue these treasury bills of 90 days, and the maturity will be 90 days later. 5 days after they were issued, somebody might say, okay, there's 85 days left on this paper, I don't want it, I've had enough of it, I'll sell it in the market. So they go and sell it, and maybe a liquid mutual fund may go and buy it and say, well, I'll take this paper. So that's also where they invest. They always also invest in dated government securities. The concept here is the government issues bonds sometimes for as much as 10, 15, 20 years. So a 10-year bond issued from today, that's in 2011, would go all the way till 2021. It would mature in 2021. Let's look back in history and say whatever bond was issued in 2001 will mature sometime in 2011. So that now becomes a short-term security, because if I borrow now, it might mature in say 3 or 4 months. So a 3 or 4 month left to expiry or maturity, not expiry really, maturity is the concept of a dated government security that is purchasable by a liquid mutual fund. There's also something called CBLO, which to simplify it, is just a borrowing and lending mechanism. Banks, might choose to, on the treasury operations, might choose to borrow some security, sell it in the market, and buy another security just to arbitrage the pricing a little bit. Who do they borrow it from? They could go and borrow it from a liquid fund that has the securities. The liquid fund could say, well, going to borrow it from me, I'll charge you a small interest for the period that you borrow for. That is another source of income for a liquid fund. There's debt derivatives as well. So these are the various segments that the liquid and ultra short term funds can invest in. There is also the concept of what interest rates will apply. Of course, they're not guaranteed. Short term interest rates will change every day, obviously, because there's very different patterns that are available in the market. Some bank may be really desperate and therefore willing to pay a much higher short term 80-day 90-day interest rate, versus some other bank may be full of cash and say, well, I'm not going to sell it unless I pay a very small interest rate. So the interest rates will change. It could change with liquidity patterns. For instance, March 15th is usually when corporates pay their advance taxes. They take out money from the banks and go and pay the last tax chunk to the government. The cash now moves away from the bank and goes to the government. This causes a liquidity pressure in the system. So what happens is banks try to raise money in the short term by paying higher interest rates because they don't mind. 5 days if I pay 11%, it's much simpler than me trying to give a fixed deposit to somebody else for 1 year at 11%. If I can raise it for 5 or 10 days at 11%, I don't mind. So liquidity patterns will change short-term interest rates. Obviously, interest rates itself, like the RBI might raise interest rates or decrease interest rates. The impact of this is fairly low because what happens is when the RBI says, listen, we'll increase interest rates by say 0.5%, the rates for extremely short-term paper may not change that much, because what happens is so little time left to expiry that the change in the interest rate doesn't affect them much. But for longer term, so a non-liquid mutual fund, something that is holding something that is a 10-year bond, 10 years away from maturity, that will get affected a lot more than a liquid or an ultra short term fund. But you can expect that there will be some reasonable impact. Because of this impact, you can lose principal as well. That's something that you have to understand when you take on a liquid fund. People don't usually think of it that way, and it's very rare that it's happened, but it has happened in the US in the 2008 crisis. So therefore, it is useful to be warned that you can lose principal as well. The advantage, of course, is that the higher rates that are in the market get reflected faster. So if you buy a fixed deposit from a bank, it gives you 8%. Tomorrow interest rates goes up, the bank is offering new deposits at 9%. Your 8% remains 8%, right? You don't get the extra benefit of that 9% because the bank has changed its interest rate, because your contract was at 8%, versus a short-term debt mutual fund will start seeing a higher interest rate at the short term as short-term interest rates increase as well. They just get reflected faster. The technical term, well, sort of pseudo technical term for this is that they benefit from high and flat yield curves, which is the situation right now in April 2011, where you have short-term interest rates at about 7.5. I mean, the government is paying for 90-day treasury bills, the government is paying about 7.5% interest. This is the safest deposit because it's from the government. Whereas for 10 years, the government is paying about 8.1%. So it's very narrow difference between the two rates, 90 days versus 10 years. And usually the differential is much higher. So the short-term mutual funds obviously are benefiting from this kind of yield curve. Mutual funds like liquid mutual funds and ultra short-term mutual funds also pay dividends, and that's how they usually use. Whatever interest they collect, they can pay out as dividend. Now that dividend is taxed. So the dividend tax for a liquid mutual fund, if you are an individual holder, is 25%. So if you get 100 rupees as dividend, the liquid fund has to pay 25 rupees as tax to the government. That doesn't mean you'll get 75. What they do is they know that their outgo will be 125. They pay you 100. They pay the government 25. That's the way it works. The concept here is that they want to equate it as much as possible with the tax treatment of a fixed deposit. I'll come to that at a later point. But if you're a corporate holding a liquid fund, you will pay 30%. In an ultra short term fund, regardless of who you are, the income tax, the dividend tax payable is 15%. So if you're an individual holding a liquid fund, for every 100 rupees you get, 25 rupees goes to the government. The corporate, 30 rupees goes. And for an ultra short term fund, regardless of who you are, 15 rupees goes. This is a tax differential. So while a liquid fund only invests in less than 90 days to maturity, 91 days to maturity, the ultra short terms can invest in more than 91 days, but they get a beneficial tax treatment on dividends. Also, if you sell before a year, you will pay short-term capital gains taxes. That means if you buy now and sell 90 days later, or the same mutual fund, you could use it like a rotating deposit if you like. If you sell the mutual fund before a year, any gains you make, you will pay short-term capital gains tax on. And if you sell a year after purchase, now this doesn't seem very right because it's a liquid fund, it's an ultra short-term fund. Why do you hold it for a year? I don't need the money sometimes. I might have a mutual fund that simply keeps the money and keeps rotating it in short-term rates. I don't need to exit it unless I really need the money. So if I sell a year after I purchase some units, I will only pay long-term capital gains. And long-term capital gains are inflation indexed. So if inflation this year is 7% and I sell the mutual fund next year, let us say if I make 8% return, the first 7% is considered inflation, therefore it's not counted as a gain. Subsequently, whatever is on top of the inflation, the remaining 1%, that is what is going to be added to my income or charged long-term capital tax gain rates depending on which tax system applies. Currently, until the direct tax code takes impact, you will pay long-term capital gains taxes of 20% of any indexed gains. After the direct tax comes into play, it will get added into your income and taxed to at whatever rate you are. So let's look at a fixed deposits versus the liquid or ultra short-term funds. What are fixed deposits really? You get, even if you take a 5-year fixed deposit, every year you get interest that is taxed as income for you, regardless of whether that interest is reinvested. The tax is actually deducted at source. So if they pay you 100 rupees, they will take out 10 rupees and pay you only 90. In the sense, if they were supposed to pay you 100, they'll pay you only 90. They'll say 10 rupees is tax deducted at source. This applies even if you don't come under a taxable bracket. Your principal stays guaranteed. So the bank, unless it goes bankrupt, is going to pay you back. These fixed deposits can also be used as collateral against, say, a different kind of a loan. It can be used as a backup margin for your share transactions and so on. The ultra short-term debt mutual funds or liquid mutual funds, the taxes are capital gains, so they may be long-term capital gains based on whether you sell them after a year or not. So there's slightly beneficial tax treatment possible in this case. Obviously, the dividend taxes are lower, as we've discussed that. For ultra short-term, it's much lower. For as an individual, for liquid mutual funds, you pay only 25, versus if you're in the highest bracket, you will pay 30. So there's a small differential over there. And of course, you don't have a principal guarantee with liquid or ultra short-term debt mutual funds. And if you want to take a loan, liquid funds are not so easy to use as collateral. So most likely we'll say, oh well, withdraw the money, put it into a fixed deposit. We'll take a FD as collateral. It's possible, it's just not easy. So the differences now are, obviously we've discussed the first four. We've said it's not easily pledgeable. The last difference is that you can lock your interest rate in an FD. You get 8%, it's 8%. Even if the interest rates fall tomorrow, you'll still get 8%. But the liquid funds have market determined rates. You can't say next 3 months it may be 8%, after that it may be 4, then another 5 months it may be 10. You don't know. You take an FD if interest rates are going down. That means if interest rates are starting to plunge, then you might want to lock your rate in with an FD. And if the interest rates are going up, or if the short-term rates are very high, which is the situation now in April 2011, you would want to go with a liquid or a short-term, ultra short-term mutual fund. And that's, that's just the way you can kind of differentiate about when you want to take which one. There is a tax advantage in going through a liquid or a short-term fund as well. And we'd love your comments. Email us, go visit our forums, lessons@marketvision.in, contact us at marketvision.in. We'd love to hear what you have to say, and thanks for listening.